Today we're talking about gains and losses on stock sales. Welcome to the Video CPA. I'm Michael Scott. I'm your host, where we talk about items of taxation and accounting that will impact your tax return and other parts of your financial life. So it's good to be with you today. We have, as usual, our disclaimer. This is our affiliate disclaimer saying we do get commissions if you buy something. And those links are in the description area of this video. And so if you go down to the description area and click on one of those links, go to Amazon or one of our other affiliates and buy something, we actually get a commission, and we like that. So if you need something, do it. Video CPA disclaimer, just an educational disclaimer saying that we do our best to get everything right, and I think we do get everything right, but you also have an obligation to study this out as well. All right, let's go over some definitions real quick, okay? First of all, capital asset. And a capital asset basically is defined by the IRS as personal type property. Really, it's property that you use in a personal or investment for investment use. Okay. So then they define personal property, and that's property that you use in a non-business type or a non-investment type situation. So personal property could be your house, could be a car, something like that. But it's not used in business, and if it is used in business, it's business property. But we're talking about capital assets today, and capital assets aren't business assets. So two types of capital assets we want to talk about: personal property and investment property. So investment property are assets that are used to bring about some kind of gain, some kind of income, whether a capital gain or whether it might be interest income, dividends, whatever the situation might be. That is investment property. So, in order to talk about gains and losses on stock sales, we have to talk about stock basis. And if you went through the rental videos, stock basis was covered quite carefully there on the sale of a rental house, for example. Stock basis here is also very important, and we spend quite a bit of this class talking about stock basis. So there are things that influence your stock basis, and that is stock splits will influence the stock basis. So if you have a 2-for-1 stock split, it's going to influence your stock basis, and these other things too. But in its simplest form, stock basis is basically what you paid for the stock plus any fees that you paid for the stock. The problem is they can be influenced by these other things. So let's go ahead and look at them. Stock basis, if you have a 2-for-1 split, it's going to cut your basis in half. So if you paid $10,000 for 1,000 shares of stock, and suddenly you have 2,000 shares of stock, you're going to divide 2,000 into that 10,000, and your price per share is even going to be less. So it's not going to change your total stock basis, but it is going to change your stock basis on a per share amount, which is very important because oftentimes you sell parts of your total shares that you bought, not the entire lot. So that's a stock split. Other thing is dividend reinvestment. You need to remember that if you are reinvesting your dividends and you're paying tax every year on those dividends because you send a 1099 DIV, and that means that you have to include that in income, but you're not getting any cash back yet. So those dividends go to increase your stock basis, and you know a lot of tax preparers miss that, and a lot of taxpayers are not aware of it. So that's one thing that you need to realize is that if you're paying tax on those dividends, it's going to increase your basis in that stock, and so be aware of that. That's also true of capital gains. We're going to talk about capital gains in a minute. This is mergers. So mergers are a little bit more complicated. Usually in a merger, they're going to take your stock in of the old company, and they're going to issue shares of the new company. Normally, it's a non-taxable event, but if you receive cash or receive something else in return other than just stock, it may be taxable and called boot. Okay, which is that part of it would be taxable. So you need to be aware on stock mergers just exactly what's happening, so that you can make sure your stock basis is done correctly. Now, a lot of times it's done by these brokerage firms, the big brokerage firms, and we hope they do them correctly. It's kind of hard to check them, but I've noticed that they do come out with a lot of revisions sometimes, but I think for the most part they're done correctly. All right, capital gain distributions, same thing. If you're receiving capital gain distributions and you're paying tax on those and you're not getting any money back, that goes to increase your stock basis. So make sure you keep that into account. And that's another one that tax preparers don't always get. All right, and then if you're buying multiple shares, maybe you're dollar averaging, or you buy 20 shares one day and you go buy 100 shares the next day, and then 2 months from now you buy 50 more shares, that may increase your basis. Okay, if you're using a specific identification method, it will not increase your basis, and you'll know what each one of those shares cost when you sell them, possibly. The IRS accepts actually 3 methods of calculating stock basis, and one is specific identification, as I mentioned. Another is called first in, first out. That means the first stock you bought is the first one you sell, and that's the way they price it. And most brokerage firms use first in, first out. That doesn't mean that you need to. You can tell them what you want them to use. The third method is the average cost method, and the average cost method is only available for mutual funds. So mutual funds will use that. But as you buy these stocks, if it's on a other than a first in, or a specific identification method, well then your basis is not necessarily what you paid for that stock. It's kind of a mix and match situation, but it is acceptable by the IRS. So, brokerage requirements. I mean, this was a nightmare before 2011, and when the brokerage firms had to start coming out and including the basis on all these stocks, because they hadn't done it before. And you'd be preparing a tax return and you wouldn't have a basis. You'd ask your client, and they didn't know what the basis was. They threw away their confirmations and their trade confirmations and had no idea what the basis was. And so, the IRS, they had a court decision, and it said if you're not supposed to guess at your basis, if you don't know what your basis is 0. So, boy, that's a fair way to do it, isn't it? But so tax preparers would do what they weren't supposed to do a lot of times, and trying to estimate what the basis was by looking up and seeing what the stock price was back at that particular time or near that particular time. So it was a nightmare. It's much easier now that the brokerage firms are required to do it. They've had to do so since 2011 on most things, 2012 on mutual funds, and then 2014 on things like options and fixed income investments like bonds and stuff like that. So much easier now. Okay, holding period. 1 year or less is short term. So if you hold it 1 year and you decide to sell it, you're not going to get long-term capital gain treatment. You need to wait 1 more day. So it's 1 year or less. And then more than 1 year is the long-term capital gain treatment. That is pretty simple. Those holding periods are pretty simple. So just remember, it's 1 year or less on short term, and on long term it's more than 1 year. Tax reporting requirements. Your detail stuff is reported on 8949. 8949 is a schedule that's been around now for probably 6 or 7, 8 years. I don't know. There you report the detail, and there are some exclusions to reporting the detail. After we'd done this for a while, and we had to mark every single thing that was on that brokerage statement onto the 8949, they decided that if it was a brokerage statement and if they had a cost basis, if the cost basis had been reported to the IRS, you could actually say, Okay, we have Edward Jones long term here, and just use the summary number. Okay, or short term, whatever it was. But so we can do that now. We didn't used to be able to, but it does make things a lot easier. Your summary information then rolls up to Schedule D, and so you've got two schedules there: 8949 and Schedule D. Let's go ahead and look at the tax rates for long-term capital gains now. This is 15% tax rate. You'll notice that if it's over these amounts, like a married filing jointly, if it's over 496,600, the 20% tax rate applies. Okay. And if it's art and collectibles, 28% tax rate applies to that. It doesn't matter what the amount is, but short-term capital gains are taxed as ordinary income, and that just depends on what your tax rate is. Okay, and you will notice here that for a married filing jointly in 2020, they can make up to $80,000 in capital gains and not have any tax on those. So there is a exemption kind of on your capital gains treatment. Now, the calculation for capital gains tax on a stock sale is basically your cost basis, if you figured that right, your cost basis, deducted from your sales price. And your sales price can have sales fees in it and stuff like that. So your sales price minus your cost basis is your gain or loss on that particular stock sale. Pretty easy calculation. The only problem is it's influenced by all these things that adjust the cost basis. If you have a loss, that loss can be applied indefinitely to gains, if there's gains, if you've got capital gains. But if there's not enough capital gains, that loss can only be written off at $3,000 a year. And it can be carried forward for a long time. So $3,000 a year until it's exhausted, basically. So, but you can't take that whole loss if you don't have gains to write it off against, if it's, of course, over $3,000. All right, as a bonus for watching, we are starting a tax preparation school, and it's called the Video CPA School of Tax and Accounting. We've got a free class out here for you. It's kind of the first class that we've done. It's a very easy class. It's on rental property, recording rental revenue on Schedule E. And you'd think, well, that's really easy, but this class is probably take you an hour, maybe 2 hours, but it does teach you about rental revenue if you're interested in learning that. So you can get that at www.thevideocpa.com. Now, unfortunately, you can't hit on that link because this is a picture of a slide, basically. So it just will not work here. But remember that, www.thevideocpa.com. It's a free class. You'll have to go out there and register and then take your class. And we will be adding more classes, hopefully, each week until we've got a good number of classes out there. At which time we'll start to charge for the classes. All right, there are a few adjustments. I'm only going to talk about one today, and that's the wash sales rule. So if you buy a stock and you've owned it for a while, and then you turn around and sell it at a loss, and then you turn around the next week and buy it back again, that's called a wash sale. And they don't allow you the loss in that situation. So still may be a good investment, but you're not going to get your loss. So if it's 30 days before, 30 days after, so you get like 61 days there. So if you buy it though and turn around and sell it within 30 days, you're not getting your loss. So that's the wash sales rule. All right, that's it for today. Fairly easy subject. Just look it over, watch the video, and appreciate you watching and following along. Thanks for liking. Thanks for subscribing. Now, one last thing before you go. Remember to enroll for the free class. If you do enroll, give me some feedback in the comments section. I need to know how long it takes you to take it, because I'd like to submit it for continuing education approval. And I'd like to know if you see any problems with it or any ways to improve it. So get back to me on that if you would. And thank you very much.